Hello and welcome back to The Roaming Investor, the channel where we turn your real estate dreams into achievable goals. If you're new here, I'm your host, your guide in the ever-exciting world of real estate investing. Today, we're diving into a crucial skill for any investor, running the numbers to identify a diamond in the rough. So, if you're ready to make informed investment decisions, keep watching. And if you enjoy our content, don't forget to hit that like button and subscribe for more real estate insights. In today's episode, we'll break down the steps to accurately analyze real estate investments. We'll cover everything from understanding the market to calculating your potential ROI. Whether you're a seasoned investor or just starting out, these tips will help you make smarter, more profitable decisions. Let's get started. Understanding the market. First things first, understanding your market is crucial. It's not just about the property, but where it's located. We'll explore how to research local market trends, average rent prices, and vacancy rates. Remember, a good investor knows their terrain. Researching local market trends, average rent prices, and vacancy rates is a vital part of real estate investment analysis. Here's a step-by-step guide on how to conduct this research effectively. Websites like Zillow, Realtor.com, Redfin, and others provide extensive data on various real estate markets. You can find information on average rent prices, property values, and historical price trends. Many local governments and housing authorities publish reports on housing markets, including vacancy rates, median rents, and demographic changes. This data is often very detailed and specific to your area of interest. Look at current rental listings on websites such as Craigslist, Apartments.com, or local property management sites. This will give you a sense of the going rates for different property types and sizes in your target area. Real estate agents have first-hand knowledge of the local market. They can provide insights into rental rates, neighborhood trends, and future developments that might affect your investment. There are tools and software designed for real estate market analysis. These can provide in-depth data on market trends, rent averages, and other important metrics. If possible, visit the area where you plan to invest. Observe the neighborhoods, talk to locals, and get a feel for the rental market and community dynamics. Join local real estate investment groups or online forums. Networking with other investors can provide valuable insights and real-time data about the local market conditions. Economic growth, job market health, population growth, and demographic shifts can all impact real estate markets. Sources like the U.S. Census Bureau can provide this data. Local news sources often report on real estate developments, changes in the economy, and other factors that can influence the real estate market. Keep an eye on future development plans in the area, such as new commercial projects, infrastructure development, or zoning changes, as these can significantly impact property values and rental markets. By combining these methods, you can gain a comprehensive understanding of local market trends, average rent prices, and vacancy rates, which are crucial for making informed real estate investment decisions. Calculating net operating income (NOI). Next up, let's talk about NOI, net operating income. This is the total income from the property minus operating expenses. We'll show you how to calculate NOI and why it's a key figure in evaluating your investment. Calculating net operating income (NOI) is a fundamental aspect of evaluating real estate investments. NOI is critical because it provides a clear picture of a property's profitability before financing and taxes, allowing investors to assess the property's income-generating potential. Here's how to calculate NOI and why it's so important. Start by determining the total gross income your property generates. This includes all rental income and any other income sources like laundry facilities, parking fees, etc. Deduct an allowance for vacancy and credit losses from the gross income. This accounts for potential periods when the property may not be fully occupied, or when tenants fail to pay rent. Compile all operating expenses associated with the property. This includes property management fees, maintenance and repair costs, property taxes, insurance, utilities if not paid by tenants, and other regular expenses necessary to keep the property running. Operating expenses do not include mortgage payments, capital expenditures, or depreciation. Subtract the total operating expenses from the adjusted gross income after accounting for vacancy and credit losses. The formula is NOI's total gross income, vacancy and credit losses, total operating expenses. Let me explain this to you. Suppose your rental property generates $120,000 annually in rent and other income, with an estimated vacancy and credit loss of $10,000. The total annual operating expenses are $40,000. The NOI would be calculated as NOI-A $120,000, $10,000, $40,000. That makes $70,000. Why NOI is key in evaluating investment. NOI directly reflects the property's capacity to generate income after covering operating expenses, indicating its profitability. Lenders often look at NOI to determine a property's ability to cover its debt obligations, impacting loan approvals and terms. NOI allows investors to compare the performance of different properties regardless of their financing, providing a standardized profitability measure. NOI is used in the capitalization rate formula to determine the property's value, making it essential for accurate property valuation. Regularly calculating NOI helps in monitoring the property's financial performance over time, identifying trends, and making informed management decisions. Understanding and effectively calculating NOI is crucial for any real estate investor, as it serves as a fundamental metric in assessing the financial health and potential of a real estate investment. The 1% rule. Next, have you heard of the 1% rule? This simple guideline can quickly tell you if a property is worth considering. If the monthly rent is at least 1% of the purchase price, it's a green light for further analysis. We'll dive into how to apply this rule effectively. Imagine you're eyeing a property listed for $250,000. According to the 1% rule, for this investment to be worth considering, the monthly rent should be at least 1% of $250,000. So, let's do the math. 1% of $250,000 is $2,500. This means you should aim to rent the property for at least $2,500 per month. Now, let's evaluate this. If similar properties in the area only rent for around $2,800 a month, this property wouldn't meet the 1% rule. On the other hand, if you find that comparable properties are indeed renting for around $2,500 or more, then this property passes the 1% rule and merits further analysis. It's important to remember that the 1% rule is a starting point, not a definitive decision maker. It quickly filters out unviable options, but further analysis of expenses, market conditions, and growth potential is still essential to make a well-informed decision. By applying this rule, you can swiftly gauge whether a property deserves a closer look. This way, you spend more time on promising investments and less time on those that don't meet your criteria. And there you have it, folks. By following these steps, you'll be well on your way to making savvy real estate investments. Remember, the key is in the details. The more thorough your analysis, the better your chances of success. Today, we've learned how to evaluate the market, calculate NOI, and apply the 1% rule. There are other topics we can add, such as analyzing cash flow, factoring in financing, and understanding essential metrics like cap rate and cash-on-cash return. But that will be in another blog. I hope this episode has given you the confidence to run the numbers like a pro. If you found these tips helpful, give us a thumbs up and share your thoughts in the comments below. Have any specific questions or topics you want us to cover? Let us know. Until next time, keep roaming and keep investing.